Hey friends, Tommy here at StoragePug. I just wrapped up the inaugural episode of Storage Academy Live with Chang. He and I broke down the state of the storage industry, what the Fed's up to, what the markets are up to, what the REITs are up to, how's AI going to change anything. It's a fantastic listen. So if you're on YouTube or listen to us on a podcast, strap in, come ready to learn. It's going to be a fun episode. Y'all have fun. Hey, friends of the storage industry, Tommy here with StoragePug. We are live for the first time ever, Storage Academy Live, the inaugural episode. I'm so stoked about this. I've got my dear friend, Chang. John, this is what, our third or fourth year
Yeah,
together doing State of the
yeah.
Industry. I feel like my year can't really start until we hang out, right? So happy Lunar New Year to you. It's the year of the horse. I was born in 1990, so this is my year. And I'm glad you're here, man. How have you been?
Doing great, doing great. It's such a crazy year. It's keeping me busy, but a lot of things to talk about and a lot of fun.
We've got a packed hour and lots of folks joining in the audience. Also, a ton of folks in the chat session right now. There's also a live Q&A tool. So right next to your chat bubble, there is a Q&A tool. So I'll be monitoring that. So that'll be if you have a live question, it's way easier for me to flag if you use the Q&A tool. And of course, if you're watching this in the future on YouTube or on our podcast or within Storage Academy, hello from the past. Well, today's Thursday. February 26th, it's 2 p.m. It's Storage Academy Live. I'm excited to dive in. So let's jump in. So temperature check, John. What are we seeing, right? Like, just catch me up on the economic trends that we ended 2025 with. What did you see when it comes to rent demand stabilization, investor landscape? Catch me up on those things from what y'all are seeing from the markets and Millichap side.
Well, there is so much going on, and you have like 5 different topics rolled into that
I know.
question.
It was a loaded question. I know.
The thing is that we're in a really, really weird place, economically speaking. So, what, a week ago, we had the Supreme Court strike down the tariffs. I was literally on stage talking about things that could possibly happen when that did happen. And so you never know exactly when those things are going to roll out. So we had that happen. Then within the next day, we have new tariffs blossoming up, replace them.
15%.
10% everywhere. No, wait, let's make it 15. Let's just go big. So the economy keeps moving in different ways. And you look at job creation, and it really just got crushed last year. We were averaging, like 125,000 jobs per month in 2024. Then the first quarter of 2025 was okay. And then the second, everything from May through December and since has been really rough. We only added about 1,500 jobs per month on average in that cycle. So that's something we're keeping an eye on. Unemployment rate's pretty stable. We still see economic growth. The chance of a recession, according to most economists, is still low. So we're just in this weird place where the economy continues to grow. The job creation is stalling out, but still positive, generally speaking. We had some months where it went negative. And the unemployment rate is kind of stable. There's less job openings than there were. And so you end up in this really weird place economically that we really haven't been in pretty much ever, where we're still growing, but we're not adding jobs. And, the jobless recovery that everybody talks about. And it's really creating a lot of nuances that is going to affect all types of commercial real estate, but including storage as we go forward. So as I look at the industry, there's some things that are positive, and there are definitely some headwinds, and it kind of gets market specific once you get past the initial look at how trends are flowing. So I don't know, Tommy. What you seen anything different?
Yeah, I mean, no, the uncertainty that you're speaking of, right? I mean, the fact that you're on stage and one of the possibilities happens while you're, talking about it it's indicative of what's going on, right? So there's that piece. What we're seeing on the storage side, right? Like from a rent and or demand stabilization, I think move-ins are relatively flat, right? Year over year in most markets. Obviously, we'll get into it. We've got an hour to hang out with each other, so we'll dig into some of the more regional specific places. But generally speaking, demand was relatively flat. So that's the good news from and this was comparing Q4 2024 to Q4 2025 specifically. So like the good news is demand was relatively flat, which means obviously we want demand to increase, but demand was relatively flat, but also occupancy remained relatively flat also. So most operators kind of just held on, we were slip sliding from like the end of 2022, right? And then we did our State
Yeah.
of the Union 2023, and we definitely broke into to discuss like, hey, we don't know where we're headed, but it's probably going to be rocky. Well, turns out you were right, John. It was rocky, and it continued to be rocky, and we kind of like hit. I want to knock on wood to say that we had officially hit the bottom, but I think at least year over year from 2024 to 2025, it did feel like a lot of places hit that high 70s mark from an occupancy perspective, and kind of like stayed there. And again, we can dig into all the different regional differences and nuance, but specifically though, like so that's what we're seeing, at least from the self-storage specific things, right? But now let's get into some of these market specific market conditions. So like, are you seeing how has this market saturation played out regionally, right? And I know Marcus Millichap, y'all track it from like Northeast, Southeast, Midwest, West Coast. That's kind of how y'all see the landscape as well, right?
Well, we're looking at more on a metro basis all around the country,
Got it.
but and I think we have a lot of nuances out there. I think we still have some headwinds in front of us,
Yes.
right? As investors, as operators, there are still challenges. We're still building a fair amount of storage facilities, so the new supply creates some challenges. Absorption, yeah, it's kind of flat, and it's I haven't seen any real burst of growth that suggests things are going to get better. And in fact, as I was saying earlier, with the stall in job creation, I think a couple of the key drivers of space demand are going to face some challenges. One is the household formation, which, if you think back historically, household formation is one of the key metrics I track for self-storage to assess what does the absorption outlook look like.
Mm-hmm.
And the other thing is that with slowing job creation, you have less mobility. Fewer people are moving around the country. So you have markets, maybe across the Sun Belt where we have maybe extra development, which was betting on job creation and in-migration to fill those spaces. And that's going to take longer than many had expected. So there's just this strange climate that we're operating in that we'll move out of eventually. But as you look across the country, you have markets that just built too much space. There's too much competition. They're still in the lease-up process. You have markets that have been relatively slow to develop, and very little has come online. And they're outperforming. So you can look. I'm just going to flip over here in my visuals and just say, some of the top performing markets, right? San Diego, Indianapolis, Cleveland, San Antonio, St. Louis, Inland Empire, Southeast Florida. So those are some of the markets where we see the vacancy changes are improving.
Mm-hmm.
You see some weakening in Sacramento and Nashville, Houston, Charlotte. So there's a lot of variance depending on the key metro. And one of the other big things that I've been thinking about a lot for the storage industry is how the REITs have changed the playing field, and they've changed it in their favor. and what that means for the private investor and how the private investor is going to operate going forward. I think that's going to probably be for most of the people on this call. I think that that's going to be something that is going to be challenging.
Well, do you think, I mean, let's jump into that, right? I think this is a pretty hot topic amongst independent operators, amongst regional third-party management operators and private investors who have owned their storage businesses since the 80s, right? This is a pretty big topic, and I think it's some of these conversations are not being had at the national stage, and I think this is a good place to dive into it. So, do you think a lot of this was inevitable after institutional capital discovered the beauty of self-storage?
Yes, but this happens to everything, right? It's the gentrification of the sector. It is the evolution of the sector, and it is the emergence of basically what are category killers, right? So
Yes.
it's like if you go back 50 years and there were little hardware stores everywhere, and then Home Depot and Lowe's comes through and knocks most of those out. You look at small mom and pop retailers in the small towns, and Walmart rolls into town, and everybody's quality of life improves except for the people who are running those little shops that get knocked out of business. And so this is a natural evolution of the business cycle. And quite frankly, storage is one of the last property types to go through this evolution.
Yes.
And so it really forces investors and operators to really think strategically about how are they going to play in this game. The institutions, the REITs are going to come in and they bring in lots of data, a lot of systemization, a lot of technology. Their customer acquisition resources and tools are stronger. And for an individual operator, it's just very difficult to compete. And so I think as we go forward, everybody's going to have to come to some decisions on how they're going to play this game in the future.
Well, let's talk about that, right? So what's the REIT playbook, right? So I mean, you got Extra Space, you got Public, you've got Cube, you've got NSA, U-Haul is up there, right? And now there's a couple other, like Smart Stop, and there's some really cool groups that are doing, trying to do big things. And so, what does it look like, right? Like, what is their playbook generally right now? I mean, they do the rate slashing, right? Like a really awesome online web rate or awesome street rate, and then you get in, and then it's customer rate increases, right? That's the general playbook, but like it's more than that. It has to be more than that, right, John? Like that can't just be it.
So they have a lot of inherent advantages.
Yeah.
Number one, they have the data, right? So they know people's propensity to stay at a unit as they raise rates. And so they are able to play this game, and they have the systemization to do it, where they can go in, offer a discounted street rate, and then start driving up rents very aggressively and move to their quote unquote stabilized rate. That is a cornerstone of their strategy, because it's how do we build market share? How do we acquire tenants? How do we fill space? And then we start rejiggering the rents until we get to the sweet spot for that market and that location. And they also have a huge balance sheet. So if they stub their toe along the way and say, oh, we pushed things a little too hard, they can weather the storm, they can reset, and they can keep moving. But also they have the balance sheet to invest in technology. They have the balance sheet to have leading website capabilities and apps for phones and all of these things that give them unique competitive advantages relative to a smaller operator who just doesn't have the data. They don't have the infrastructure, the technology, the web presence, the brand, if you will, that draws in the customers. So it's going up against Home Depot in the hardware space is not easy, but it can be done.
It can be done. Well, let's talk about that, right? So, like, I'm racking my brain, John. Right? You mentioned the Home Depot, Lowe's. I mean, that's a great example because it's very obvious and clear, right? Like now, at least regionally, we have Ace Hardware, and I try to support Ace when I can, right? But like
Yeah.
Ace doesn't have everything I need, so I also go to Lowe's, right? And
Yeah.
so in that scenario, yeah, all the teeny tiny mom and pop independent hardware stores, unless you're in a really teeny tiny town, it's basically gone to Lowe's and or Home Depot. Um, how can we shelter? Like, what are you suggesting storage operators do? I mean, you listed several of the playbook, right? You've got the rates play, you've got the huge balance sheet that allows you to invest in technologies, in people, in data, in websites, in performance, in weathering the storm, because you know that you can play a numbers game. People are going to move out, but not everyone's going to move out, right? So like you
Yep.
can weather some of those storms because you have this huge backing as an independent operator, which we've got 150 people on live right now. How can these folks go toe to toe with such a playbook?
Well, the entire strategy is not to go toe to toe. And
Okay.
you're right. So you got Ace Hardware. One of their strategies is, hey, we're going to carry stuff that you're not going to find at Home Depot or Lowe's. We're going to have a differentiation on our product. And again, I think that's an opportunity. The strength of the REITs is they have systems and they can run this over and over and over again. The weakness of that is they cannot adapt, they cannot flex, they cannot shift to accommodate unique opportunities.
That's
So
really cool.
when you look at a private operator, you're going to have to adapt, right? A box is a box is a box. And so economies of scale are going to win. And you're just not going to beat them if all you're doing is you're leasing space. Even if you're right across the street, your customer acquisition is just not going to be as strong. Your ability to play around with the rates and generate profitability through that model is not strong. But what you can do is you can cater to specific segments of the market, right? Whether small businesses or you can adapt your storage to unique composition. So, man caves, toy storage, car storage, wine storage, or these other unique facets of storage. In order to differentiate your product line, the service you're providing is going to be different from what they offer across the street at one of the REIT operated shops. So that's one way to do it. Another way to do it is to play where the REITs can't go, right? So if you're in a smaller market, if you're in an outlying market where they just can't get the scale to operate effectively, then you are relatively isolated from that competition where those models don't play. And I think in a lot of the smaller market, relationships matter. You can be in there and the neighbors and the people using the facility, and you can have a conversation. And quite frankly, and I just ran this data yesterday, and I basically took what's happening in storage rents in the largest markets in the country, the 50 biggest major metros, compared to everything else, not in those 50 markets. And the rent growth in the small markets is much better than what you're seeing in the major cities. The average rent is higher, and generally speaking, the performance is better. So you're simply avoiding that trap of competing with the juggernaut by geographically creating distance and going someplace where they can't play.
I think that's got to be the strategy. Like if you're in Brooklyn, good luck. I mean, it's going to be hard. It's going to be a slugfest, right? But if you're a new operator, then yeah, let's not look there. Let's try to look elsewhere. And I think this is where you got data we may not have the gazillion data points that Extra Space has or Public Storage has, right? We may not have data scientists like them, but there are data platforms available out there, right? I'll name drop a few that our own clients use. course, Marcus Millichap publishes reports. Yardi Matrix published reports. Radius Plus, Tracked IQ. I mean, there are tools out there now that maybe a decade ago didn't exist.
Oh yeah.
You know,
There's a lot more. There's a lot more resources available. But
absolutely.
what you don't have is what many operators may not have is specific data management and data mining tools for their clients, their customers,
Yes.
where they have a big enough data set where they can say, you know what, 90% of people are okay with the first rate hike of up to whatever 10%, whatever that number is,
Right.
and so they say okay, and they can look at the math and say, in net, if this holds true to the average that we've seen across 1,000 stores, this is where what we're gonna see happen. And you just don't have access to that resource, so you're gonna have to play the local competitive climate. If you are operating in one of the major cities and you are competing with those major institutions, the other option is you may have a lower basis on the property, where you can simply you can still fight them on a price battle because of your basis on your real estate is so low, and your cost of your real estate side of your business is lower. You may have higher operating expenses, but you can balance it out and still compete on price. And really, unless you have this is business school stuff, right? Unless you have something differentiating you from your competition, and you get into a price competition, it's a race to the bottom.
True.
And whoever can outlast wins. But that's a tough way to fight the war.
It's because when one army's got more treasures and ammo and assets, they'll just outlast you. they'll take a few losses, and you eventually have nothing left. So
Andrew brings up. I just saw this thing. The spotlight thing. Andrew brings up a good point. Okay, but the thing is it's a numbers game for the REIT, right? So they're gonna just keep plowing away at it. But again, this is where customer service and customer relationships matter. If you can build those, you can build that long-term customer who stays there forever and never comes in and sees their stuff. But the ideal for the storage, and the REITs are starting to get some pushback when you look at what's happening in New York and the lawsuits that are emerging up there over the trade practices. This eventually, I hear a lot of people talk about this rate game, and they don't like it at all.
No.
So,
No.
but by the same token, I've heard people say, yeah, I don't like it, and I know it's going to happen, but it's still, cheaper to go over there for that.
Yeah, today it's cheaper.
Yeah.
Right? Today it's cheaper, and I'm going to move out in the next month, right? So it won't impact me. I mean, that's the mindset of a rookie storage user, right? Which is a real thing. But at the same time, to Andrew's point here, I think that is an opportunity to flex a little bit of like, hey, we got you. And I think some of my clients who do go to toe with the REITs, no matter the door color, they kind of get excited because they know that there will be just natural demand for better service, if just knowing the games that the REITs are probably playing, right? And then I say games, it is a business, right? These are business tactics, business strategies that they're just as valid as any. And in fact, if you look at earnings and NOI, like they're pretty valid strategies. But ultimately, you have an opportunity to flex. And I want to shout out Lee, who's the former president of the TNSSA. He is the general manager at North Shore Pellissippi Storage, actually just like 7 minutes from my office. I can throw a rock and almost get there. But we visited their offices this week, and they were so proud of it. They pointed out some of the stuff that I thought was like fascinating to me, that they are proud about this thing. They built an entire little coffee lounge, which, to your point, John, like your average storage customer doesn't care about that or want that. But the ones who do, that is another level that the REITs are not likely to invest in a coffee lounge, right? And another thing that Lee did, this was years ago, he had a customer leave their wallet at the counter after they had done all the paperwork. the customer was going to the airport after they left the storage facility. So the customer calls and said, "Hey, I think I left my wallet. Can you help me find it? I'm going to miss this flight." So Lee was like, "Let me just drive it to the airport for you." And that's an example. And again, that's it's an anecdote. That's one small little moment. But when you add those up, those stories compound, and especially for the operators who not only deliver exceptional service, but they are very digitally savvy to get those 5-star reviews online. When you add those two things together, it really paints a nice picture for your storage business. That we got you. We care about service. We care about taking care of our customers. We are in the community, and it is not just about money for us. Everyone knows business is money, but it's not just the money. We also want to make sure that we deliver on our promise, whatever that promise might be. And so I think those are, to me, really cool stories and cool opportunities for local independent operators to go crush it. So anyway, so John, I think you hit the nail right on the head. We got a few Q&A I want to dig into. That's kind of related to this world. But someone made a comment like, are there, this drop down, is it leading up to giving them the opportunity to snatch up facilities at good rates? Do you see that happening? Is there any truth to that strategy, or is that more of just like a feeling that people might have?
Wait, I'm not clear on
the question I think that Jeff posed here, I'll put it in the spotlight, is the REITs are driving down basically the values of independent operators because of low occupancy, low rent, etc., with the intent to snatch them up at a discounted rate, basically, to go in and say, "Hey, we'll either manage this facility for you, or we'll buy it off of you." And so, are the numbers backing up that narrative?
So, I don't think that that's the core of the strategy, right? The core of the strategy is how do we maximize our revenue and our profitability as an organization, because these are publicly traded organizations. They are working in the best interest of their investors and driving a dividend to that base. And so, the idea that we're just going to knock all these guys out and we're going to buy them up on the cheap.
Mr. Burns isn't sitting there.
Yeah. I mean,
I've met Ken Woolley, and he is not Mr. Burns. At least I don't think.
So I don't think that is the ambition. I think that is a side effect, right? So you are going to drive the inefficient operators, or the people who really just can't compete, or they don't have the will to compete. And those are acquisition opportunities if those properties are inside the box.
That's cool.
And so again, it's not that this is the evil empires coming in trying to take over everything. It's really that they have an efficient business model that works a certain way. And as long as you understand this is how their business model works, this is their strategy, they're not changing it, they're not adapting on the fly to the local market, they're going to run their playbook. It is a machine, right? So you as an operator, you sit down and you say, look, either we're going to find a way to beat these guys through differentiation, or we should probably sell out and sell it to them and get the best deal we can today. And quite frankly, the transaction market is liquid. The transaction climate is accretive. There, you can generate a good return, and that is an option. Even if you take that money that you made and you go invest it someplace where you're not going to have to compete with the REITs. I mean, the storage business. Maybe you move out to a smaller outlying area in the same kind of metro. And get out into the fringe where you're not going to be competing head to head with that.
Yeah, no, that's killer. So yeah, Jeff, I mean, yeah, I think your question is extremely valid, but I think John hit it again very nail on the head there. It's like it's an outcome. It was not the goal, it was not the intent, but I think it's a side effect of the state of things, and it's an opportunistic thing, right? And I want to claw back to this comment I spotlighted, because I think Andrew, also you hit this nail on the head. Economy of scale is a real thing. Lowe's, Walmart's, those big corporations, they have advantages in supply chain, et cetera, that don't quite apply to self-storage, right? Just because you have 20 stores in Sacramento doesn't necessarily mean you're going to succeed with 20 stores in Phoenix, right?
Sure.
Like there's there's an overlap, of course, of improvements, website data, all that kind of stuff, but like those things, it's not a given that you're going to succeed in those areas. So that's a really great call out, Andrew. So thanks for chiming in there. John, before we leave the REITs behind, because I think we can probably talk 2 hours on this topic, but any
Yeah.
final remarks on what the REITs are doing and or how we as independent operators can go compete with the REITs better?
I think that we need to keep our finger on the pulse of this, and again, I understand that they don't have the same advantages as say a Walmart or some of these others, but they would like to, and and they're going to try to,
They're gonna try to. Yeah.
and so, but I think that there is going to be pushback. The storage industry is still quite young in the grand scheme of things. You compare it to how long have apartments been around? How long have office buildings or retail centers? How long have these types of real estate been out there? And how have the business models been developed over time? And even with as sophisticated as those industries are, the predominant investor in all of these types of real estates is still private investors. It is still individuals. It is still small investors. So, it's not like we're going to completely erase the competition. And if you look back at the last, let's say, 10 years, let's call it the last 5 years, who has been the dominant buyer of self-storage, and it is private investors. It's about 60% on average over the last 5 years of the acquisitions have been by private investors. And REITs, they're a big piece of the market, but it's still like 20%, give or take, of the transactions are done by REITs. So they are the big monster in the room for our day-to-day business and what we're looking at and how we view it as an industry, but there is still a small portion of the total asset base and the total competitive climate.
I love that. No, and there's still regional and market-based advantages that you have that you mentioned earlier that the REITs can't tap into yet. They would like to, and they would love to
Yeah.
figure this out. And they're encouraged to do so. But yeah, there are still things that we as independent operators can hold strong, and many do. And I see it in the comments.
Yeah.
Katie says she just hit 80+% on an expansion. Bunch of other people are holding up high 80s. Some people are in the 90s occupancy wise and holding up rates. And I saw a bunch of other comments where folks are they love competing with the REITs because of the advantage that we talked about here. So we're gonna leave the REITs behind, but we're gonna use them as a ramp off to the next thing, which is going to impact our industry, and it has already, and that's regulation. That's legislation that's going to tell us what to do with our businesses, and without getting too moral or philosophical about this, we want to stick to the facts here. There's been recent lawsuits filed against Extra Space, New York City being one of them. California has several others going. New York State's got a few, and there are a bunch of other states that have kind of like jumped on. Connecticut, I think, been another one. So what's happening there, John? Can you speak to that to just from a high level for the folks who may not be aware? Catch us up on what's going on legislatively that might impact the industry as a whole.
So I'm not as in tune with that. I get bits and pieces, but essentially what it boils down to is what are the fair trade practices, right? What is reasonable, and are you taking advantage of people? This is always going to be around, but it doesn't have the same level of pushback as you see in multifamily, for example, where you have whole states going in and setting rent growth. And in some metros, they're even saying when a unit goes vacant, when you rent it to the next one, you have to rent it for the same price you rented to the last guy. You can't raise the rents in between when you have a vacancy. And so you have a much more regulated climate for that industry, for apartments, than you do in storage. And I think that there's less traction on storage. I think that again, we got to all watch our competitors and ourselves and make sure that we're not getting out over our skis and doing anything too reckless. But I think it's a nuisance more than it is a catastrophic issue.
No, I think you're right. Yeah. So I've been kind of following Scott Zucker, and I just heard Joe Doherty from the SSA speak in Asheville just a couple weeks ago, and the high level is, to John said, it's lawsuits that really intend. I think the heart of it is to help businesses run a fair business, and fair for the consumer, but also it's bleeding onto like monopolistic antitrust type stuff, right? Because it's giving larger businesses an unequal or an unfair advantage that smaller operators may not be able to have. And then the main ones are like, rent increases. Is there a cap to this? And if there is a cap, what is that cap? What is fair? And then, of course, from the industry's perspective, I think there are arguments to be made that, the legislation has to be clear with guidelines, and it has to be enforceable, and it has to be fair. And there's some there, I'm so far removed, and I know I'm glad this was not the lifestyle that I chose for myself. But apparently, all these bills go back and forth, and there's compromises and negotiations and all these kinds of things, and lobbyists jump in. But ultimately, whatever ends up happening, there needs to be fairness and equity. And it's all going to shake out eventually. And I think I don't say these bait and switch tactics, because I think that might be too strong, but I think these business practices have led the consumer to feel a certain way about our industry, and we don't want
pisses people off.
Yeah, we don't want the spotlight like that, right? We already featured on CSI Miami and Law and Order SVU. There's murdered bodies in our businesses, and then we have Pawn Stars. We're selling. Or no, not Pawn Stars, Storage Wars.
Storage Wars.
Yeah. We're selling people's things, right? Like, we already have that kind of spotlight on our industry. We don't want another thing. So I think, much to your advice about keeping a pulse on the REITs in general, be mindful of that. If you're not in New York City, if you're not in California, if you're not in Connecticut, if you're not in these markets where these things are actively happening, my recommendation is to stay tuned with your state association, because they're on top of it. They're reporting on this. They are in tune with the legislation in your local government, and they're the best source to keep you informed.
I'm going to one up you on that part, because the people who make the rules don't know our business. They come in and they're like, oh, everybody's whining, let's make them happy. So then they toss them a bone and they create a rule, which may be a terrible rule for those consumers and for the business and the industry, and they don't have a clue. Honestly, a few years ago, I went to the White House to meet with them to talk about 1031 exchanges, and I literally sat down with the expert. And I said, okay, tell me, how much do you know about 1031 exchanges? And he's like, all right, just start with the basics. Pretend I don't know anything. And I'm like, all right, let's do that, because that person is going to influence the decision, and I need to help them understand what the implications of that decision will be. And we were able to stop the 1031, the elimination of 1031 exchanges by educating them on exactly what they were screwing around with.
Yeah.
Now, by the same token, not only should you stay in tune with your associations, I literally would say you need to be an active participant, and you need to financially support those institutions, because they are going to be your advocate when the bad things come. They're going to be educating the legislators to help them understand, look, I know it looks like a simple thing, but it's not. If you play this card over here, you can create downstream effects that are significant, and you need to be aware of that. At least go in with your eyes wide open. And so we as business people need to support these organizations so that they can act on our behalf. So it's not even just a passive thing of stay in tune, but I think everybody on this call needs to, at some level, and I'm not saying you need to give them $1 million. I'm saying give something to help provide defensive shelter for yourselves and for your businesses. It just makes sense.
Incredible, John. No, call your local reps. I mean, it's really real. Either be a part of the legislation, or the legislation will happen to you. And you're totally right. These folks don't know about how can they know about our industry unless they've participated in it, right? And I was just chatting with my Matt, my partner, yesterday. He's like, because we were talking about Knox County's budget surplus. And we were joking about the mayor, and we're like, yeah, as the mayor, who they never got training on how to deal with the budget, the size of a county, right? So like, you don't go to school for that, right? So so we put ourselves in their shoes. Like, what would I do if I had a $47 million surplus? I don't know what I would do. I would start with fixing the pot. Yeah, party. I would maybe start with fixing the potholes on the interstate. I don't know what I would do, right? But I think it's similar to our legislators who are, in these Senate meetings and representative meetings and listening to lobbyists and industry experts and all these things. They have to make a decision, and the more informed they are, the more likely they are making the best for everyone decision. Hopefully,
right?
Removing private interests out of the equation, right? And we know that that's part of it too. But ultimately, yeah, everyone's kind of guessing blindly if we're not if we don't inform and educate them. So really good advice. So yeah, so not only stay in tune, y'all, listen to John and call and be an active participant in your local government. Love that, John. And I think maybe the third call to action is like, yeah, be good at business. Like, treat your customers well, right? Like, don't be a part of the problem. Maybe would be probably potentially helpful too. So now we're going to leave the REITs completely behind, and I want to talk bigger picture that may or may not have downwind impacts on us. And if they are downwind, probably further downwind than even 2026. But Dusty asked a question earlier when you were mentioning feds and rates and all those kinds of things. What impact and what are those impacts once Jerome Powell sunsets and new person comes in?
All right, so we're going to have new guy, but he's not really a new guy. He's been in this before.
Okay.
And, he was a Fed board governor actually during the global financial crisis. So, he knows
Kevin Warsh, by the way.
Warsh.
He's not just some guy.
He's not just some guy.
He's not just some guy. Yes.
Setting aside all the politics, but President Trump has a real clear opinion on what the Federal Reserve should be doing. And he's willing to beat the snot out of anybody who doesn't go the direction he wants to go. So, better or worse, whatever your opinion of that is, set that aside. But that is what we've seen. And so we get new guy coming in. Now, what I find very interesting and fascinating, in fact, is that during the global financial crisis, which was horrific, he's the guy, the Fed governor, saying, no, we should not reduce rates. We need to hold the rates higher. This is going to create problems. We're going to see inflation as a result, blah, 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 blah. Okay, so he was a fiscal hawk, right? He was leaning towards maintaining higher rates during this massive global recession. Now, here we are in a completely different climate. It's not nearly, anybody who went through that cycle knows this is challenging, but not like that, right? We don't have the whole financial system collapsing. Now, and so presumably, right, anybody who was taking this position and has, witnessed how Chairman Powell was treated when he didn't reduce rates, obviously has to have had some sort of conversation with the president about Well, okay, yeah, I can see an argument for reducing rates, and I can represent that. But you have to remember, there are 12 voting members on the Federal Reserve Board. Okay, this is Chairman Powell stands at the front of the room and does the press conference, and we see him as the leader. But in fact, there are 12 people who get a vote, right? And right now, if you look at the positions of the various people who have those votes, those 12 votes, very few are leaning towards rate cuts, like 2 or 3 out of the 12. So if you think about it, all right, we're going to swap out Chairman Powell, and God bless him. He's stood at the front of this through inflation and all of these other challenges, and stuck to his guns and stuck to his commitment to do his best job he could to run the Fed. But you're going to have the next guy come in, and presumably he's going to be quote unquote independent and going to try to do what's right. And so we'll see how that plays out. Right now, the predictions are maybe 1 rate cut by June, maybe 2 or 3 by the end of the year. But this is not going to be a massive drop of interest rates. And not only that, most of our lending, most of the debt we use as real estate investors is not at the overnight rate from the Federal Reserve, right? Very little is tied to anything even remotely close to that, unless you're getting variable rate financing, it's leaning on the SOFR curve and that type of thing. But generally speaking, we're looking at what happens with the 10-year Treasury. And the 10-year Treasury is, to a degree, decoupling from the Fed overnight rate right now. And that is a function of how much debt are we issuing as a country, which is rising, and who is buying that debt. And when you look at foreign investment into acquisitions of U.S. Treasuries, that has been decreasing. So there are fewer buyers than there used to be, and we have more that we're trying to sell, and that puts upward pressure on those longer term rates. There are things that are going to move that. You have days where the stock market drops, and that money moves out of stocks and it moves into bonds, and that will cause those rates to come down. In the last few weeks, we've seen the 10-year Treasury come down is around 4% right now, 4.05 ish, give or take. But it's reasonably low. And when you look at the big picture, it's about, it's actually below average if you look back 20 something years on the 10-year Treasury. So we see this a lot. We talk about this a lot about what's happening with the Federal Reserve. Right now, I don't think that's the biggest issue out there. I think that in general, we'll want to keep an eye on those 10-year Treasury rates and how we are managing the pool of buyers of those treasuries who buy our U.S. debt. And that is actually a far bigger concern for me than what the Fed does. The Fed's going to keep lowering rates as long as we don't see inflation rear up. And right now, the probability of inflation rising is pretty minimal because 44% of CPI is driven by housing inflation, and housing inflation is measured in a way that is backward looking, not forward looking. And when you look at the cost of houses in the last year, they've basically been flat. When you look at the cost of apartment rents over the last year, they've basically been 1%, give or take, maybe 2%. But basically, they're well below a 3% inflation or 2.5% inflation level that we're at today. And so we can expect that inflation will be relatively low over the course of the next year. And I think our greater concern will be job creation, but I don't even know that lowering rates is going to affect that because that's not the source of the cause.
No.
But so you boil all that down, and based on that, my prediction is, look, the Fed will probably lean into rate cuts, but not aggressively. The 10-year Treasury is going to do its own thing, but it's probably going to be pretty much range bound, somewhere around 4%, maybe 4.25. It could get bumpy, and it could be influenced by what happens in the stock market.
Wow. So one point that you mentioned there is the with the 10-year treasury bonds is our global positioning, like who buys that? Right? Like I mean that's a rhetorical question. Hopefully for the audience that's joining here live but also listening in the future, it's like, yeah, our other countries who we love and play ball with, right, buy our bonds. And yeah, things look a little different right now. And not to get too philosophical or political about any of this, but yeah, those are all things that are impacting us, not just our industry, but like our livelihoods and our beings. And I think another data point, and honestly, this is a good question that I'll ask, and that's a good segue. So, April, thanks for asking this question. What's your opinion on facilities with kiosk versus personal customer service? And I think I'll piggyback on that question and I think extend it, and it's not just a kiosk, but it's like these remotely managed facilities, right? So like that's a trend that's been going for a number of years now, right? Maybe not the kiosk, but more of the remote managed stuff. John, what's y'all's indicators? And what are you observing that's going on this year? Is this going to continue to happen? Have we reached critical mass? Is it a strategy that seems to pay off? Because I mean, I'm seeing studies that show the opposite, right? Like facilities that have staff and have managers have higher overall revenue, but obviously, you have to have control groups, and it's not comparing apples to apples. But talk to us about that, John. Like, is that a trend that we should expect to see? Is if facilities moving more towards completely remotely managed or these hub and spoke models?
So I think again, as we've been talking about, this is kind of a business model concept, right? A business decision, and the number one rule of business, at least from a marketing perspective, is understanding your customer.
Mm-hmm.
All right,
Mm-hmm.
and so when you look at the demographics of storage users, they're leaning younger and younger, right? The boomers are great, right? But they're only 13% of the user base, whereas they're 26% of the population. So they under index. Gen X, like me, 24% of the user base, 26% of the population. So again, they under index by a little bit. Millennials, 42% usage compared to 29% of the population. So they over index, and Gen Z over indexes a little bit as well. So basically, the point is the consumer base is leaning younger. And it's going to sustain with those age cohorts as we roll forward. We've already seen this. This isn't new information. This has been out there for a couple of years. This trend's been evolving. And so when you look at automation and those types of capabilities, first of all, traditionally, automation has gotten cheaper and cheaper and cheaper over time as the technology and the efficiency of producing that technology increases. So then the cost of implementing it falls. And the adoption of technology by younger generations is higher. So when you look at what do my customers need, what do they want, that resource does range up there. It's not as as important as pricing, right? People are most sensitive to pricing, but anytime access to the unit is kind of number two, and electronic gates is number three. So you start working down, the study from the SSA, and you start looking at the things that people value in the industry, and that is up there on the list. And I think it's going to increase its utilization and the demand for these things as technology continues to be adopted. The ability to walk up to a storage facility and use my phone and just push a button on my phone, get access, go in, access my unit very easily, quickly, and at any time that it's convenient for me becomes important.
Very important.
Now, does that mean you don't need service? No, you still need service. I think you still need people to interact with customers who want that interaction or need that interaction or need them to drive, to drive the wallet to the airport or whatever it is. And I think if you're looking at, more outlying areas, a storage facility where It's at a vacation destination where people store all their toys there, or when you have local businesses or farmers or whatever storing equipment there, then those relationships become even more important relative to the technology. So know your customer is the bottom line there.
No, straight up. And Mandy says this. I mean, she answered it in the thread there for April, and it's and I'll quote it in case folks didn't miss it. Is I truly believe that all humans crave a personal interaction besides a computer-based experience because it comes down to empathy and understanding. Yeah, and I think there's more than one way to deliver that, but I think you're so right, Mandy, and especially with we're being inundated with support by robots, and in all different ways, right? And some of it is great. Well, I don't know. Some of it is okay, and much of it is not great, honestly, right? And I think there's like, oh, cool, this is a nice surprise. This fellow human is here to help me, and they care, and I can see and I can sense it, right? And this facility's nice and clean and spotless, and all the lights are on. All the things that matters, right? So, John, knowing your customer is a big deal. So April, I think that's a fair question, but I really think it comes down to know your market, know your customers, and yeah, there's probably at some point, if we haven't already, I don't know that we've crossed this threshold, but there probably at some point it's a marketing strategy to say that, yeah, we're support by humans. Right? Like I mean, I think like frankly, I think StoragePug, I think we're at that place where we can we're pretty proud that we're supported by real humans with real blood and hearts and guts right here in Knoxville, Tennessee, and I think storage operators, we're getting to almost to that point where that might actually be a value prop. Not for everybody, right? Like there are some customers who don't care about it, but I think it's potentially one of those extra things that you can highlight about the way you do business.
Let me jump in real quick here, though. So just think about restaurants, right? There are times where I want to get my order, put it in, do it on my phone, whatever, and get out as fast as I possibly can because I'm tight on time. And there are times when I want to go sit down and have a waiter who I can talk to and say, hey, what do you recommend? I want to take some time with my dinner and enjoy it. So, just again, with that example, there are going to be times when a customer really is I just want efficient, in, out, done. I don't want to talk to anybody. I don't want to deal with anybody. I'm just going to get this. I got to go drop this thing off.
Yes.
But when something goes wrong, when there's a challenge, when there is a unique circumstance, nobody wants to go and dial on the phone and start pushing buttons to get through to, some chat bot that doesn't give you a good answer. They want to talk to a real person and say, look, here's my situation. What can you do to help me? And so there is a balance there.
No, I really love that. I mean, the office knows. So we're the part of town that we're in Knoxville is Cedar Bluff, and there's a Chipotle. Shout out Chipotle, or not shout out Chipotle, but there's a Chipotle down the road, and I frequent it because it's an easy meal for the family and it's semi-healthy, right? And some of my customer interactions are worthy of like, yeah, this is how you should not do it. And so I like to go through the checkout line and like talk to the person and like do that interaction. But some days I'm like, you know what, it'll be faster if I just order on the phone and pick up in person, right? Like to skip all of that potential shenanigan. And so you're totally right. I mean, I think it's a yes and scenario and not just either or. I think it's not mutually exclusive. You kind of have to have both. And you mentioned, support by robots, and I think that's a good segue, and we can land the plane here. I think a lot of folks who came to this session want to know like AI and how that impacts things, right? I mean, some AI impacts on our society. I mean, you probably saw IBM stock drop 10% just because Anthropic rolls out an AI agent that is COBOL, that is competent in COBOL programming language, which, as many of y'all may know, that is how our financial institutions are ran. And so we've got some aged software developers who can eventually retire. Probably feel excited they can retire now because they're holding up, they're holding up the backbone of our financial institution. So like, one announcement by one AI company, not even the largest AI company, causes IBM to drop 10. Now, it's not the only thing to cause it, but pretty, little causality there. So that's pretty interesting. And of course, you've got the trend for AI support has found self-storage, right? We've got multiple options if you want an AI chatbot, multiple options if you want an AI voice agent, like if someone calls in. You've got AI, what's it called? Knowledge bases. I mean, there's, of course, AI chat tools, AI for marketing. You've got all these things. What are you thinking it's going to do to our industry? Like where are we going to be in December 2026 with your crystal magic 8 ball? What's going to
December
happen to
26th.
us?
And I'm looking at the chat, and so you read it off into this whole Chipotle thread for quite the time there, and I just laughing. And then April, I'm with you. AI freaks me out, but so look, it's being overplayed right now,
Yeah.
right? So
Yep.
okay, so I work at Marks Millichap. Marks Millichap is a publicly traded company. Some analyst somewhere says, well, real estate brokerage is going to, commercial real estate brokerage is going to get knocked out by AI. And our stock drops like a rock, and it wasn't even that bad for us. CBRE got crushed. And because this is just something that got dropped in CNBC or wherever, and it creates chaos. And right now, the investment climate is so dialed in to AI. It's like, a huge portion, 5 stocks are driving the whole stock market right now. So the thing is that we're all being inundated with this. And, honestly, with my team here in my research department, we are investigating ways to leverage AI to make us more efficient. But it does not take the people out of the equation, because the people are actually way smarter than the AI. And at the end of the day, when you look at all of the tools that are available, they could increase productivity. They could increase effectiveness. They can help your people do better, but they're not replacing the people. At least, when I look at my team, I look at it and say, what can we do with AI? Not so that I can replace you, but so that I can amplify what we can do for our clients. And that's the power, is that it acts as an accelerator. It can be an accelerator for us once we figure out how to apply it effectively. And I think a lot of businesses are in that same phase. I think that for storage, I think the application of AI into the storage business is pretty nominal. It's not, again, it's really great for data analysis or writing software code or doing those types of things, for helping people put their stuff in a box until they come out with a robot that's moving that product for them. It's really not a big thing. We can set up an Amazon warehouse with AI and have it move people's stuff around. I suppose that might help, but genuine, at the end of the day, this is not going to be the force that makes or breaks the storage industry. I think the greatest challenge is the uncertainty that it's creating, and the belief that it's going to replace people, and the ripples of that effect across the economy is actually going to affect storage more than the actual technology being implemented in the industry.
Incredible, John. No, that's well put. One day there will be robots. I think robots will probably hit the Asian markets first. They're
they're way ahead. I was watching videos, man.
It's great. It's nuts over there. I mean, it's kind of nuts over there. But at the same time, Amazon's doing crazy things with robots in America, right? I saw they had their millionth robot. I think come alive or come online this year. Hopefully, they're not coming alive, but. Yeah, eventually those things will impact us. But I think you're right. I mean, the fundamentals of our business and our industry are less less movable from an AI perspective, right? Yeah, hopefully it can augment customer support. Hopefully it can speed up analysis. Hopefully it can, the more tech savvy operators can do more things with it. But like at the end of the day, it is people moving a box into a bigger box. And how you can help them do that better is how you can win more business, right? And so I love the way you put that, man. Incredible. Well, John, we went a little over, and I appreciate all your time. I've got a question of the week for you, and then I've got a fun question too. So I've got a real question of the week, and I've got a fun question. So,
okay,
question of the week. This is a loaded question, and you can take as long as you want to answer it. I won't cut you off. What is your hottest take on the current state of the storage industry today? Hottest take.
Oh man, well, I think it's the cornerstone of what we've been talking about, which is where is this industry, and not the box in a box, right? That, not that side of the industry, but where is this business of self-storage going to go? We are navigating a very important evolutionary process, and it's going to affect every player in the sector. And so the operators really need to sit down and have a plan for how they're going to tackle this next cycle. And there's a lot of cross currents out there and all the economic stuff and the uncertainty and all that. But at the end of the day, what are you going to do with your business? Because if your whole strategy rests on, I'm going to deliver a commoditized product of storage space, I'm going to deliver a box to the market, you're going to face challenges. So you're going to have to think about where you're going to take your piece of this business and how you're going to compete in the future. I think that's the number one thing on my mind when it comes to storage.
To me, that sounds like sticking to your fundamentals. Are you answering the phone? Are you right? Are you making good economic decisions as far as marketing? Are you paying people well? Are you, all these things that are true in 2016 and true in 2006 and true in 1996. They're also true in 2026. And maybe the thing that makes it exciting or thrilling or scary, depending on the adjective of the day, is some of the pressure that's coming from institutional regulation, some of the stuff we talked about today, the uncertainty of just everything that's happening that can flip a coin and impact us. It could be exciting news that come out tomorrow or the next day that can come in and do some big things. So I like that take, man. So the fun question is are you reading anything good right now? Is there anything fun that the audience should educate them on, or just read for fun? What are you reading right now?
So I saw that note from Darby. I also want to mention that Marcus Millichap will have its 2026 self-storage investment outlook available.
So
that
read
comes
that.
out in about 30 days, give or take.
Okay.
I'm pushing to get it out by mid to late March. So awesome. We have that to look forward to. Ironically, what I'm reading right now, this sounds kind of weird, but what I'm reading right now is a Harvard Business Review guide for new managers. And the reason I'm reading that book is because I'm doing a leadership development project with some of my people. And it's a great book of little case studies and stories about how to develop new management.
I love that.
And help them grow. And I'd never read it before, and so I'm reading that with some of my people to go through these case studies and say, look, this is what you should expect, and here's what we're doing to help you navigate that process. So that's what I'm actually. Yep, that's the one right there.
I love that. I love that. Yes.
Yeah. So that's what I'm actually reading. That is literally the book I'm reading right now.
There we go. Get on. Yeah, that's how you get on John's level, y'all. No, that's awesome. Well, interestingly enough, and we did not plan this. This is crazy. I'm also reading a Harvard Business Review book. And I'm reading the top 100. I'll put it in the comment section here. It's the top 100 most influential articles and essays posted by the Harvard Business Review for their 100th anniversary. I don't know when it was published, but I'm flipping through and it's good stuff.
Yeah.
People a lot smarter than us sharing their experience and life stories, and it's incredible stuff.
Those things are pretty good. Some of those stories are amazing. Some of the insights, how what happened to Kodak? What happened to trains? Why are trains basically a commoditized product? Yeah. How to throw a monkey, right? These are just this great ideas. And it's again, Harvard Business Review.
There you go. The
There you
rise
go.
of Coke. I mean, there were just so many things, right? The 7 powers. There's just so many good things, y'all. So check it out. This entire conversation, by the way, the recording, we're going to send it out via email if you attended. It's going to be posted on Storage Academy. It's also going to be posted to our YouTube. And for the folks who like to listen via ear, which I believe is all of us, but at least listen to it via podcast, we're going to launch the Storage Academy podcast early next week. We're going to upload this entire recording in its entirety, and we're going to send an email so you can check it out on Spotify, Apple Podcasts, wherever you get your podcasts. So stay tuned for that. And then next month's session, the operator's guide to AI. We talked about AI it's not going to flip our industry upside down like it might has the potential to do for other industry, but there are practical ways to either implement AI or at least make yourself aware of AI. So we're going to do a hands-on workshop, and I'm going to dig in on how AI can impact not only your customer's journey, but your internal business practices and how you run your business better. And funny enough, we're going to focus a lot on human-centered love and support with customer journey. No surprise if you've been to any number of our past webinars or know anything about StoragePug, very human-centered around here. So AI can augment, but should not replace. There's our thesis for next month. But stay tuned for that. That's in March. It's going to be live right here in Storage Academy Live. Today, I had Chang join us from Millichap. Incredible insights from my good man. John, just as we're exiting here, give the 30-second overview of Marcus and Millichap. I imagine anyone who joined live or listened to this in the future know who y'all are. But tell the audience, who is Marcus and Millichap and what makes self-storage so exciting to your company?
Marcus Millichap is a leading commercial real estate brokerage company. We help investors buy, sell, and finance real estate. Actually, the Real Deal just published something, I think it came out yesterday, where they ranked the top brokerage firms in different types of real estate. And Marcus Millichap is the leader, number one, in self-storage brokerage. So we help more investors buy and sell storage than any other company. So that's key. I run our research services team, and we have a whole team of dedicated analysts that sit down and help me put all of this information and insight together and share it with our investors. You can access our reports on marcusmillichap.com. We provide those to investors with one purpose in mind, which is how can I help an investor create and preserve wealth, do better by providing useful information. So there's no charge for that. You go in, you do have to register to get access to it, but that's there. And you can also follow me on LinkedIn. I do a weekly video where I talk about things like, what just happened with the tariffs or something like that, and try to make sense of what we're seeing in the business world every day from a commercial real estate lens. So that's who we are. That's what we do. And that's why we do it.
I love that, man. I love that you're here. I love that you've been doing this for so long. I love the passion that you still have. I love that you still dream about it and talk in your sleep about it. But honestly, I love that y'all publish these detailed reports and make it available to anyone who cares, anyone who opts in for free. And it's high quality stuff. Our team consumes it here at StoragePug. We love this stuff, and we appreciate y'all for doing it. And honestly, we appreciate all your time and insight. And go ahead and book your calendar for next year. We'll see you Storage Academy live in 2027, baby.
All right.
Unless we're replaced by our AI selves.
Right.
You'll see me and
avatars.
Yes, John. Thanks so much, my friend.
Hey, it's always a pleasure. I love having the conversations with you, Tommy.
You're the man. See ya.